Hi everyone, my name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to October's edition of InvestNow's Monthly Wrap-Up. At InvestNow, one of our guiding investment principles is to stay informed but avoid the noise. That means, while we recognize it is important to keep abreast of what's happening in markets, we also believe that investors should be mindful of resisting the urge to change their long-term investment strategies solely in response to market volatility and noise. We know, however, that financial markets can often feel unnecessarily complicated with so many headlines clamoring for our attention. It can be hard to keep up with what's relevant and what isn't. But don't worry, InvestNow is here to help. Each month, together with one of our expert fund managers we have on our platform, we'll distill the key events in the wide world of investments into digestible bites curated for the Kiwi investor. Today, I'm joined by Greg Fleming, Head of Global Diversified Funds at Salt Funds Management, one of the leading fund managers we have on InvestNow, and winner of Research IP's Boutique Fund Manager of the Year in 2023. Greg's kindly joined us today to help break down a busy month in markets over October. Greg, thanks for joining us.
Hi, Jason. Thanks.
Cool. Let's kick into the October market wrap-up then, shall we? As it's certainly been an eventful time in markets on multiple fronts. So, Greg, October's come and gone, and in this market dashboard, which we've handily summarized the recent performance of a few key indices, like local as well as global bonds and shares, were there any particular pockets in the market that stood out to you?
I think the last 3 months in October being chief of them has tested the nerves of many investors. And it's clearly a pretty negative story through to the end of October, through to Halloween. You see a great deal of drawdown in both bonds and equities accumulating there. I think an important point to note is that this is after a pretty rigorous rebound rally in many of the equity sectors earlier in the year, as part of the recovery or the uptrend post-bear market of 2022. So this kind of pattern of red is corrective after an over-enthusiastic rebound rally that probably got ahead of itself by mid-year. If you look across there, you can see that the Australasian equity markets were even weaker than global shares, which has been the pattern for New Zealand, certainly for most of the last year. There are some domestic causes in there in respect of interest rates, also government uncertainty. The longer duration assets, such as property and infrastructure, also markedly weaker. Then on the currency side, you've seen consistent weakness in the NZD, along with many other currencies against USD. So an unhedged position has been more beneficial there than being fully hedged.
Yeah, so diving a bit deeper into the weak markets we've seen recently, it's worth highlighting that 3 negative months in a row, like we've seen in the 3 months to October, is actually quite a rare event, with this only happening 3 times in the last decade, at least with the S&P 500. And it didn't even happen last year when markets were uniformly red across the board. Greg, did you have any thoughts on the particular drivers behind this bad streak we've seen recently, and maybe contrasted with what we've seen in the past?
Yes, I think that there's quite a few drivers, and coming on top of excess optimism, investors can always be vulnerable to revising their mood into a negative direction. This is what we really saw in the 3 months leading to the end of October. I think that you had geopolitical events starting to come back to cloud sort of the outlook. There was a sense also that the interest rate picture was still unclear, that there'd been several bouts of too early calls of a pivot from the world central banks from tightening bias into neutral bias and then ultimately into easing bias. And the central banks in their various statements have been at pains to point out that inflation is not low enough as yet to pivot towards easing, and that conditions will need to be kept tighter for longer. Same time, other catalysts in the interest rate markets were the deteriorating fiscal position. And it's not just in the US that this is true, although that's the most marked instance of it. The greater borrowing requirements of many government treasuries around the world has come much more into focus in the last 12 months. So in the US, there was great fear that the newly required issuance of bonds would be at all-time record levels, and that therefore the interest rate burden on the US taxpayer would just go up and up and up. As it turned out, the reality when Janet Yellen issued the new borrowing requirements for the second half of this year were not so severe as had been feared, but it certainly spooked the markets. At the same time, other investors in Asia, the Chinese and Japanese central banks, for example, not reinvesting as much in the treasury market as they had previously, lowering their overall holdings in their reserve management suite. And finally, the sense that government bonds may actually have an element of credit risk creeping in, even though they're meant to be risk-free assets, has really unnerved investors in other asset classes as well, because just of that question of the commitments that governments have undertaken in the last 3 or 4 years to offset weak economies with stimulatory spending.
Yeah, there's definitely been like an upshoot in borrowing just post-COVID. We've really been unprecedented, just how much borrowing that the government has been doing, and you can kind of see in this chart here with bond yields once again making headlines, both the 10-year and the 30-year US Treasuries, eclipsing that like psychologically important 5% threshold. I mean, something it hasn't done since 2007. So kind of honing in on that, Greg, does this finally make bonds quite attractive to you?
Depends on the bond, Jason, to be honest. Yeah, absolutely. I mean, there's no doubt that with not only nominal but real yields up in solidly positive territory for the first time in many, many years, bonds broadly are worth a look. And on valuation levels also, their valuation is considerably better, having been extremely overvalued for much of the last decade. They have now become kind of around fair value on our estimates, perhaps a little bit cheap in some parts of the curve. So yes, however, there are various issues with bonds at the moment still. With sovereign bonds, you do still have these problems of debt issuance and future fiscal requirements. There has been a lot of overpromising by governments about what government can pay for, given the level of tax revenues that are actually plausible. And that's around the developed world at the moment. For the other parts of the bond universe, and if you look at, say, corporate bonds, there are some very good quality corporate bonds out there, and I definitely say that they're worth looking at. They have very juicy yields, advantageous yields at the moment. The lower quality bonds have actually been the stronger performers, interestingly, because they're the ones that get hit hardest in recessions. And because recession hasn't really eventuated in the US, investors in those bonds have been rewarded for taking on the risk. But nevertheless, we are at the point globally where the credit cycle is turning. And that means that issuers that have got away with issuing at very low yields will begin to need to refinance their bonds at higher yields. And investors may demand a bit more of a risk premium from those issuers. Simultaneously, credit rating agencies are looking more closely at the finances and their interest coverage and things like that of corporate issuers. And because they're looking more, the scrutiny is more intense, there may be some credit downgrades ahead. So that's a trap for young players, and you shouldn't go unadvised into corporate bonds. It's definitely important to pick and choose the quality and the outlook for credits as well.
Yeah. And probably the key message there is that, an active approach to bond management is definitely something that brings a lot of value, especially in the New Zealand market. So, this is something that you guys take, especially with a sustainable lens in your global fixed fund over at SALT.
Yes, we do. We're highly active, really. We've got the view that the established global bond benchmark is very, very, very diverse. 27,000 securities in there, dominated by the largest sovereign debt issuers. The US and Japan and China. Which is fine if you're in for the long haul, because all of those economies are not emerging world economies. They've got actually quite stable growth paths, but they are volatile as well, particularly China. So we sort of say, let's build up a bond portfolio as if you had nothing in there to start with, from the ground up. And our partners, Morgan Stanley, are extremely skilled at that. So they say, what would you need if you wanted a good representation across global fixed income? Then they apply a sustainability lens, which means that they will be more inclined to hold issuers that have high sustainability scores. And that actually includes some green bond issuers where the bond is specifically linked to a sustainability project and has deliverables that have to be met. And that's a new part of the bond market. It's a growing one. And it's one that we were fortunate enough to be able to access quite early and bring to New Zealand investors quite early.
Nice. Yeah, who says bonds are boring, eh? So kind of moving on to the next, probably the other key event that happened over the month of October, and that was the outbreak of the Israel-Hamas war. So we saw plenty of headlines, both in mainstream and in financial media, and we certainly sympathize with the human tragedy element in all this. But just maybe focusing on just the impact on financial markets, the reaction was initially at least uniformly negative due to the higher risk and uncertainty involved anytime war breaks out. But Greg, could you maybe give us your thoughts on this particular conflict in Gaza and its impact on markets, and perhaps maybe geopolitical risks more generally in terms of whether these types of wars really move and shake markets enough that people should be scrambling to cash, gold, or dare I even say Bitcoin, or whether there's potentially risk of an overreaction here from investors.
Well, I mean, they say Hamas has got plenty of Bitcoin. That's the latest headline I've seen. So scramble if you wish. But I think generally, though, the context of this war was already markets having kind of accustomed themselves to the Ukraine conflict and the inflationary impact of that conflict on agricultural commodity prices, particularly. And then, of course, with the pivots sort of moving to the Middle East, naturally enough, the focus goes on to energy prices. And this was happening at a point in time where oil prices had rallied very strongly. So there was already a high oil price and fears that these energy prices were going to be unrelieved inflationary pressures going forward over the next year. So anything that involves the Middle East and that involves a removal of détente or an intensification of stresses in a volatile region does upset investors. And when inflation is going to be the consequence, of course, you get a risk-off trade. The interesting thing was how little flight to quality there was on the breakout of this conflict. Typically, you would have seen big buying of US Treasury bonds, of the Swiss franc, of the yen, of other safe haven assets around the world. Gold, as you mentioned, Jason. There was actually surprisingly little of that. I think because investors took a wait-and-see approach about whether the conflict would broaden into a regional powder keg situation. And as it's been managed so far, that doesn't appear to have happened, which is just very, very positive. Also, we've got to remember that we're not as dependent globally on Middle Eastern oil as once we were. There are other sources. The US is a net oil exporter now. There are large stockpiles around the world, and there are economies that have transitioned partially from oil to other alternative energy sources. So it's not 1974 again, is sort of the short answer on that. And markets have become more comfortable that there will be a gradual resolution, despite the very unfortunate humanitarian side of this conflict, that won't spill over into Europe or to wider markets.
Cool. So kind of the key message there is that there is, it's a non-zero chance of risk of this, obviously, war expanding further. But for the most part, we think that there's no need to panic here. And for the long-term investors, they should really stay the course in terms of their overall investment strategy.
Yeah, I think that there's what I call like black swan breeding farms at the moment. And these black swan breeding farms are in the financial media, particularly television. And I always smile to myself because, the original black swan was a completely unforeseeable event. But now the term has come to mean just something that's unfortunate and has come a little bit out of nowhere, which is not really what a black swan is in markets. If you can talk about it in advance, it probably isn't a black swan. But geopolitics gets whipped up into being something that will get clicks and it will get viewers on CNBC or on Bloomberg TV or whatever it happens to be, locked to their screens. And so you can't blame the anchors for overstressing the risks to markets. But yeah, it's just something that longer term investors have to take in their stride and turn down the noise on.
Yep. Cool. Hit the nail on the head there, Greg. So kind of turning to key events that are closer to home for the Kiwi investor, as we touched on, the New Zealand equity market and property market in particular has taken a beating over the last 3 months or so. Off the back of that ascent in bond yields that largely followed the skyrocket in yields we've seen in other developed markets globally. Is there a cause for concern here that this difficult environment that a lot of people are refixing into higher and higher mortgage rates? Are we expecting this to be longer, be higher for longer type rates, or do you potentially see a light at the end of the tunnel here for Kiwis?
Well, what is good is that the last few inflation prints, US, Europe, and here, have been slightly less severe than we're expected. They've surprised positively. That's not to say that the inflation story is, turning roses. It's still in the underlying core domestically engendered inflation factors, which are wages based and property rental cost based. Those are still high pressures on inflation. But the international tradable factors of inflation have dropped off, which is very good. And indeed, in China, you're actually seeing some slight deflation there. There was a time when China used to export disinflation to the world, and then that turned into a time when it exported a little inflationary stress. Now it's once again exporting disinflationary pressure. In terms of how central banks react to it, I think what they don't want to give is the signal to markets that it's an all clear and yields can rally. Because while yields have stayed high in the longer end of bond markets, they've actually tightened financial conditions. Fed has talked about that explicitly, and that takes the place of interest rate hikes at the official cash rate or the Fed funds rate overnight level. So those more restrictive financial conditions are doing the work of the central bank. Were the central banks to signal that the coast is clear, then those long ends would no longer be a restrictive force in the economy, and the central banks might have to return to raising shorter rates. So it's a seesaw of message management from central banks. But they can justify moving to a slightly more neutral tone in their statements, which is what we've seen. Because we are seeing good base effects and diminishing industrial and consumer inflation pressures. It's probably not always a straight curve down as it was a sharp jolt up. There'll be points at which inflation will still surprise a little on the higher side going forward. But the broad trend is moving back to a sustainable level, if not within the mandated band, at the top or bouncing along the top of the mandated band. So that's a better picture. Once lending banks, high street banks, retail banks, get confident that they're not going to be caught short on their overall book positioning, they can start competitively reducing mortgage rates. But we wouldn't expect to see that until mid next year at the earliest.
Yeah, sounds about right. So mid next year is potentially the kind of date to circle in your calendar for now. So the other key event in New Zealand over October was, of course, the election. And although there's still a few details to iron out there, some highly sought over positions in cabinet, we know for certain that New Zealanders demanded and got change, with the Blue Nami seeing National and a new Prime Minister take over. So from a Kiwi investor's perspective, Greg, interested in getting your thoughts on whether this materially changes the outlook for the New Zealand market, and or whether money should or shouldn't be invested in certain pockets, given now that we have this new government.
Yeah, it's a very good question, Jason. I think, it's hard to deny, politics notwithstanding, that the New Zealand market has been kind of stagnating for the last year or more after a very, very strong run previously when it outperformed global markets. We've had a couple of years in which it's markedly underperformed. And the interesting thing is that it's underperformed in very strong world markets with similar interest rates prevailing here as are prevailing in the US, for example. So there must be some qualities to the NZ economy that have perturbed investors. I think there's a sense that business policy and tax policy towards corporates hasn't really been sensitive enough to maintaining decent margins for corporate operators in New Zealand. Margin pressure's been intense and severe for a long time. A lot of medium and smaller businesses are really just holding on by their fingernails at the moment. And they're certainly, I think, among the factor or the faction that wanted to see change. We haven't seen policy announcements from the new government yet. I imagine we'll see them today. or you'll have them soon. But what we would expect is some quite strong signaling that pressures will be taken off the SME sector, and that will flow up to investment in the larger capitalisation listed sector too. So signaling to offshore investors in New Zealand and domestic investors in the Kiwi market should be, on balance, rather positive.
Yep, cool, great stuff. So this probably segues quite nicely into our chart of the month here, which touches on the question of whether the New Zealand share market is fairly or undervalued. And we have this nice chart here provided by Salt. Greg, could you maybe walk us through what the rule of 20 is when it comes to fair valuations in equity markets, and what that means, and where the New Zealand market sits in relation to this?
Sure. There are many ways of obviously, as everyone knows, conducting valuations on individual stocks and aggregating them up to a market level. But there was an old rule, it's not an invention of recent financial modeling, where you could just get a kind of ballpark estimate for valuation of not just NZ, but of any global equity market. So you look at the forward price earnings ratio. That's where analysts expect earnings growth to be over the 12 months ahead. And you can see this kind of shorthanded in different publications. You see it sort of 12M or 12MFPE, things like that. It's just to distinguish it from the historical price earnings ratio, which is measured earnings that have already been reported. In contrast, the forward PE is the current price discounted for the expected earnings growth over a 12-month period ahead, for example. So if you take that figure and you might adjust it for your own assumptions, you don't need to necessarily take a broker's estimate of that or a research house's estimate of that. And then you look at the CPI, and you add them together. If the result of the sum of those two is 20, you're around fair value. If it's less than 20, you're looking at an inexpensive market. And if it's more than 20, you're looking at a more expensive market. So we've come off a period when the New Zealand market, by all metrics, has been really rather expensive. Compared to bond yields, compared to earnings, compared to many factors. And of course, as happens in markets, narratives spring up to explain this. A few years ago, there was a master narrative going around that it was KiwiSaver inflows that were doing it. And then there was another narrative that we were a more defensively oriented market, which is true, but that doesn't necessarily explain overvaluation. And then there have been other narratives that we have some kind of industries that aren't represented globally, and that we should all get more exposure to. That's true, but it wouldn't necessarily drive overvaluation. So what we then saw is a sort of a drop in our relative valuation towards fair value, and it's come down over the last year. On this metric, it's come back to its long-term average, roughly its long-term average level. Not cheap yet, but at least it's not an expensive market. So on a valuation basis, you can say it's more justifiable to look at NZ equities than others. You might as well look at it another way and say, well, that's always going to happen after several years of flat performance or of underperformance. That's just going to develop naturally or organically from that. And we're sort of saying now that while we've kind of been shunning in multi-sector funds excess exposure to New Zealand compared to global, we're moving into a position where we'd be more inclined to look at NZ at an equivalent or neutral level relative to global.
Yep, cool, brilliant. Thanks for that insightful explanation on how you see valuations. It aligns quite well with InvestNow's other kind of key principle of understanding the risks inherent in investments, where it's important for investors to understand the fundamental behavior of different asset classes like bonds versus equities in terms of their relationship between risk and reward, and particularly how they're valued, with the views of valuation from professional and award-winning managers like Salt in this space being super helpful for investors to avoid kind of blindly just diving into investments. So it's certainly been very informative, Greg, and a nice wrap-up of events that occurred over the last month. Could we maybe get your view then, as we're fast approaching the end of the year, what your outlook is on markets more broadly as we head into 2024?
Sure. We've been tending to look for entry points into equity exposure. I think that's the first point I should make. We've been broadly optimistic on global equities all year, while also aware that it was a very jagged upward path that we were going to be traversing because of that interest rate risk. And that's played out. There have been periods when you've had bull market resumptions. There have been periods when there have been corrections, and people have called the rebounds just a bear market rally. Then, I think one great comment I saw, and I'll repeat this for the audience, is that now markets are influenced by these master narratives, and everyone positions for one single view of outcomes, whether it be soft landing, hard landing, no landing. And there seems to be the capacity to only believe one thing. And now we've moved off a dark view, a dark master narrative of a hard landing into a kind of almost Goldilocks narrative for next year. I think the truth will lie between the two. That the lagged impact of the tightenings that we've seen are still to come through in the US and here, and that will repress activity next year. So there will be a slower economy. However, there won't be any more restriction added to it. I think that's key. So as the main policy rates peak and begin to be reduced from mid next year onwards, that will be a tailwind to equities generally. Bonds has already started to price it in, which is remarkably early. We previously might have thought that would happen early next year, first quarter next year. It started happening already in November this year, which has been a massive uplift to real assets, to listed real assets like property and infrastructure, which had, as you say, Jason, been the laggards previously. So a very rapid turn in sentiment towards long duration interest rate sensitive equities has happened in the last 6 weeks, and we expect that to continue right into the beginning of next year.
Yeah, great stuff. And I trust that you've been reflecting these views in the SALT Sustainable Growth Fund that you manage.
Certainly have. As I say up there at the top, neutral rating to global equities in that fund is 35%. We've been at 38 for the last 3 months, waiting for this turn towards a more optimistic outlook based on a better interest rate path, but also on quality, because that fund focuses on the quality metrics, the factors that protect corporate earnings even through downturns. So what we're saying is valuation risk has been reduced but not removed. So we covered that earlier. Earnings risk is still elevated because margins are high and costs have been very, very high for businesses to absorb. Most of the cost cutting that is plausible has been done. So there has to be margin defense and re-expansion next year, and markets looking very carefully to see that happens. But this particular portfolio looks at pricing power, recurring revenues as determinants of quality, also high return on operating capital and invested capital. Now, when you do get the economic downturn and softening, which can happen next year due to these lagged impacts of shocks and prior tightnesses, those are the companies that can still protect their revenues. And they are the ones that outperform in slightly cooler economic conditions. They don't have to have booming growth in order to add value and to accumulate gains to shareholders. So that's the emphasis there. We're quite happy to ride out ups and downs over the shorter term because the quality proposition plays out over the longer term.
Perfect. Thanks, Greg. So any final comments or perhaps like a cheeky year-end target for the S&P 500 or the New Zealand market?
I think that we probably are going to ride the wings of a relief rally. For now, I think there was so much negativity in markets by the end of October. You got the classic seasonality, the third quarter, the worst months historically turned out to be the worst months in 2023. And that is a script, and when that script plays out, you can get a kind of reconsideration as what we've seen in the last 6 weeks. I think that, the target for in-year S&P could be, in an optimistic case, it could be closing in on its previous all-time high of 4,800. I wouldn't see it up there myself, but I'd see it moving in that direction. I think NZ, it needed to get past the election, so I'm less confident to make an upside target for NZX. But certainly, the global markets could do another 3 to 5% by year end, quite credibly.
Nice. Okay, well, you heard it here first. So, be on the lookout for Santa because we may see a Santa Claus rally.
Yes.
Cool. So that's about a wrap up then on the InvestNow Market Wrap-Up. Greg, thanks so much once again for your time and excellent insight. Obviously, you guys have been busy putting those insights to work and racking up the awards over at Salt. If you want to check out more from Salt and all the great work that Greg and his team does, check out the Salt landing page on investnow.co.nz, where you can find out more and invest into Greg's Sustainable Growth Fund that we have available within the InvestNow KiwiSaver Scheme, alongside 3 other Salt funds that we have available on the wider InvestNow platform. If you want to check out the written market wrap-up piece accompanying this video, check out the link on the screen. Otherwise, Greg, thanks and once again for your time, and thanks everyone. We'll catch you next month.
Thanks all.